Hello, everybody. This is a little bit of a special film I'll be doing here tonight. Not really related to the markets. It's a little bit of an attempt to be share with you some of my academic thoughts regarding investment and monetary policy, and also to give you a little bit of my take on two Chicago traditions. Anybody who knows me or follows me knows that I am at heart a Chicago economist. I'm not educated at Chicago, but my mind is clearly very much University of Chicago, very much in the tradition of Milton, Friedman, and Gary Becker, I would say. When it comes to my view of the financial markets and how the financial markets works, I'm also very much in the tradition of Chicago, mostly of Eugene Fama, of course. And this is actually what I want to talk about. How do we reconcile, on the one hand, Milton Friedman, and on the other hand, Eugene Fama? Because I do think that both traditions exist at the University of Chicago, even though the Fama tradition, that of finance, has become much stronger than that of monetary policy thinking since Milton Friedman left Chicago in 1977, and particularly over the last 1 or 2 decades, where Chicago has drifted towards very much a dominance coming from finance, and where, in my view, the monetarist tradition at Chicago has to a very large extent disappeared, and I think that's too bad. And so what's the difference between Eugene Fama and Milton Friedman? How we should think about it? Well, I think Eugene Fama once said that Milton Friedman had said about his PhD thesis that it wasn't really economics, that Friedman wasn't sure that what Fama was doing in terms of finance really had anything to do with economics. I think Friedman was wrong on that, and Friedman probably thought so as well. But there is something to it. And on the other hand, if we follow the way University of Chicago economist professors today talk about monetary policy and macroeconomics, it very much seems to be coming from a general equilibrium perspective, very much from the kind of thinking we have in University of Chicago finance. So it's much more in line with real business cycle modeling and so forth. Doesn't mean that money is not important, but money, in the sense that Milton Friedman was talking about, it has mostly disappeared from the way University of Chicago economists today talk about the economy, and I think that's very, very sad and unfortunate. And I think it would be very helpful if monetarism had a rebirth at the University of Chicago. Obviously, students at the university still read Friedman and the classics, but in the general way we are thinking about it, it's very much from a general equilibrium perspective, and money is really, to a very large extent, considered to be neutral. I think that's a problem, and I also think that's a problem from the perspective of how finance people are educated in the present day Chicago tradition. So what's the problem? Well, one thing that I find extremely interesting, and something I spend quite a lot of time on these days, is studying the development in asset allocation, the development of what was called the Fama French factor models, and what factors can be explained to make investment decisions, and how do we explain stock market returns, but also returns in fixed income and FX markets. How do we explain that? And there I think Eugene Fama's work with Kenneth French on factor models is really important and interesting. It's something I'm very much inspired by. I think we can learn a lot about markets from that. And essentially, I think we should think of markets as generally efficient, and we then can try to see what efficiencies we cannot explain or anomalies. And some of those, why is value, for example, important for stock market performance? Why is size important for individual stock market performances? And then the big question, of course, something Eugene Fama really don't like, why is momentum important? Why does it seem that again and again we empirically seem to find evidence that certain markets that have done well yesterday continue to do well tomorrow? So had the Turkish lira been appreciating in the previous period, it helps us explain the performance going forward and helps explain why it would do well going forward, or for the same for a given stock or for fixed income markets and so forth. And across all kinds of asset classes, we seem to find that momentum is important. My big hero in terms of this is, of course, Cliff Asness, the founder of AQR, very much at heart a Chicagoan. Of course, he got his PhD from Chicago. And I think Cliff has done fantastic work, and I think the work that is coming out of AQR is in general extremely interesting. However, when I study the quants, the Chicago style quants that we see out there, I also see that they work in a tradition of general equilibrium, or at least they do not recognize that money in any way is important for markets. So when we go to the Fama French three-factor model from the early 90s that tried to explain stock market performance based on a few factors, size, for example, quality, valuation. Fama and French do not differentiate between different periods in their estimation, and look at it and about what monetary regime was in place at a certain time, which I find quite odd. Particularly if you've been brought up writing your master's thesis at a place where Milton Friedman was king, or should I say God. Why wouldn't you take into account what monetary policy, monetary conditions, monetary regimes, what role they play? I don't understand that. And if I go through a lot of the modern day quant papers, I find basically no references to monetary policy. None whatsoever. I find most of these papers tremendously insightful, but they're micro papers. They seem to assume that monetary policy does not exist. They seem to assume that money plays no role in the workings of the economy, that it's nearly assuming super neutrality of money. And then taking into account how many of the present day quants have a background at the University of Chicago and the tradition of Fama, and later the tradition developed by people such as Cliff Asness, I find it odd that money is so absent in the entire discussion. I think that should and could be changed. And I think what we ought to do is go back 170 years and read what John Stuart Mill wrote about monetary policy. 170 years ago, John Stuart Mill suggested that the economy, that there is a monetary machine in the economy, and as long as the monetary machine is well functioning, the real part of the economy is well functioning. However, if the monetary machine breaks down, the real machine breaks down. I think that's very much right. If we go back to understanding macroeconomic theory and micro theory and finance, this is important. Why is this important? It's important because if we think about all our finance models. Money is not existent in those models. The models are essentially Valrasian in their character. All finance models are basically without money. Money plays no role, or at least money is assumed to be super neutral. Super neutrality is assumed, and therefore money is not important. And here I'm not talking about interest rates. I'm talking about the demand and supply for money and what role it might play if there's disruptions to the monetary system. So, and again, if I go to look at all of the modern day quants, some of them call themselves macro quants, but I say that most of the macro quants I've seen has a very rudimentarian understanding on macroeconomics and have essentially no understanding of monetary policy, certainly not in the tradition of Milton Friedman. They talk about monetary policy as rate hiking cycles and rate cutting cycles, and they talk about phases in the macroeconomy, but they don't talk about the demand and supply for money and how there might be imbalances between this, and how monetary policy failure might play a role, and what role monetary rules play. Would you really expect that when you test, for example, whether momentum is an important factor in explaining stock market returns over time in the US, that there is no importance of whether the Fed is operating a fixed exchange rate policy as during the Bretton Woods, or a floating exchange rate policy as after Bretton Woods, or later a more clearly defined inflation target and a floating exchange rate? Wouldn't you expect that if there is no monetary stability, these factors would play out in a different way? Would you suggest that momentum would work the same way in a hyperinflationary economy as we see in Venezuela now, or in a deflationary economy in Japan? And I should say Japan. Why am I mentioning Japan? Because I a couple of days ago saw an interview with Eugene Fama, old interview, where he says, and he didn't like it, that momentum seems to be working everywhere and in all markets, with the exception of Japan. And then I thought, well, Eugene, why didn't Gene think about one specific thing about Japan? Deflation, monetary policy failure, no monetary anchor. Is there relationship between the fact that the monetary regime essentially broke down 2 decades ago in Japan, and they've been struggling with the monetary regime ever since? And for example, what momentum means for stocks? Is there a relationship? I'm unaware of anybody who has consistently tested different styles, different factors across different monetary regimes, where they took into account specifically the monetary regime and what that might mean for these factors. I think that's important. That's the missing link between the Gene Fama and the Milton Friedman Chicago. We need to reconcile, or we need to reintroduce money into the Chicago thinking, and particularly we need to take money and monetary failure into the thinking within finance, Chicago style finance. That would also mean that when we, for example, test 3-factor, 4-factor, 5-factor models in the tradition of Fama and French, and I should say Cliff Asness, we need to take into account the importance of monetary failure and the monetary regime and how that changes. There have been some work done on the importance of liquidity, but liquidity on whether liquidity of certain stocks are important. but I talk about macro liquidity. I talk about periods of easing monetary policy and contracting monetary conditions. What do we have there? And again, here there's also, as long as we have a global dollar standard to a very large extent, what I have called the global monetary superpower. So I think actually I stole that from my friend David Beckworth. But global monetary superpowers, the global monetary cycle, what impact does that have on the way these different factors in different factor models actually explain stock market performance, FX performance, fixed income performance? If you go to practitioners, trading floor economists, they would be pretty aware that what they consider as risk-off periods where market liquidity tightens, certain asset classes, higher quality asset classes, performs better than in periods where the opposite is happening. They normally don't talk about this as in monetary terms. They talk about it as risk off, or the market is afraid of, or liquidity is becoming tighter, but not in general monetary terms. But rarely is it tested in any models. And the Chicago style quants seem to ignore it. They talk about, now we can see this factor is performing, this factor is not performing, value is performing, growth is performing, quality is performing. But rarely is it discussed why different factors perform different ways at different times, and why they are important and might not be important. I can say that I contributed a lot to that research. I'm sharing my views here. These views are not something that just came about now. They have been up here for a long time. But because I'm working on, or we are working on improving our general forecasting framework at the moment, and specifically is working on some FX forecasting models, I have given this more thought than normally. And therefore, I will end this little think piece by sharing a little bit of an insight to the preliminary results we have from our work on exchange rate forecasting. I just need to find it here, the paper. Got it. So what we essentially have done is that we try to say, okay, can we try to look at 6, 12, 30 months performance on exchange rates, but use the same kind of models as you would do on the equity side in the French Fama tradition. So what we do is we took a number of emerging market currencies and a number of developed market currencies, and then we looked at 12 months changes in that, and try to make a model, a panel data model, that could predict the expected return on these currencies. And what we did was we took 4 factors. Actually, it took 5, and one of the things that we consistently found was that carry, even though it's often being mentioned, particularly among quants, as being important, really we couldn't find carry being important, so we left that out in most of our work. But we found 4 other factors that consistently comes out as being as strong, valid, significant indicators, predictors of future FX performance. First of all is macro momentum. There we simply measure the momentum in macro variables. Is the economy accelerating or decelerating? This is likely capturing also what is happening with domestic monetary policy. In the most simple framework, we simply looked at 6 months innovations in unemployment. The second thing we looked at was price momentum. Is there a momentum in the exchange rate itself, and can we use that to predict future developments in the exchange rate? Thirdly, we looked at what we call quality. Quality, we actually constructed a numerous quality indices. What they capture is everything from macro volatility, price stability, economic development. We measure that by GDP per capita. Institutional qualities, we look at economic freedom, for example, level of corruption. We look at credit ratings. We look at numerous factors and try to construct a quality index. And we found that, doesn't really matter how we construct it, but quality is a tremendously important factor. It measures all economic, institutional, and financial developments. So high quality would be a country like Switzerland. Low quality would be a country that are typical emerging markets or frontier market. And a country that has deteriorating quality would be a country like Turkey, where institutional framework has been deteriorating recently. So what do we find? We will find that all of these factors are important. First of all, we find that macro momentum is supportive under any circumstances. That if the economy is doing better, if we look ahead, it has predictive power in terms of how the currency will be doing in the future. We also find that valuation is important. These are currencies undervalued on a PPP basis. It will strengthen in the future. We find that price momentum is important, very much in line with the literature, but there is a but, and I'll get back to that. And that's it. Macro momentum, price momentum, quality, and valuation, those are our factors. They do tremendously well in explaining future innovations in exchange rate, future development in exchange rates. That does not mean that they can beat the market, because then they would need to beat forwards. We really haven't tested that. My experience is that we can build models that historically have been doing better than forwards, but that we have close to market efficiency, that often these factors will predict something very similar to what is already priced in forwards. But nonetheless, these are strong predictive factors. But what comes out generally is that we do not only do this in a Fama French style of modeling. We take into account the global monetary cycle. And what we have done is we have looked at what we call a global liquidity indicator. And the global liquidity indicator is based on market data. It's a yield curve, it's commodity prices, it's the dollar, it's credit spreads. And why all is that? These are things that we would tend to see move in one direction or the other when a global tightening of monetary conditions are announced. This indicator we compare also to our hard monetary indicators. Money supply growth, exchange rates, nominal GDP growth, and interest rates. And we will see when we compare the global liquidity indicator, which is market-based, and our global monetary indicator, which is hard data-based, these two are very, very closely related. So what we do is that we look at momentum in our global liquidity indicator. And what we see is then when we construct models where we take the global liquidity indicator and define periods of monetary easing, global monetary easing and global monetary contraction, and have these two phases. We could have looked at also a medium phase, but we have only these two phases. Then that has a tremendous impact on the importance of the different factors: macro momentum, price momentum, quality, and valuation. First of all, valuation, there is no impact. Valuation has the same importance in both scenarios, so that's not really important. But what we find is that macro momentum is important, but becomes even more important when there's a global liquidity tightening. So your currency would tend to do even better if you are in a situation where your economy is growing strongly, but we have global monetary contraction. In terms of quality, we actually find that in periods of monetary easing, quality means nothing. So if there's a lot of liquidity around, buy crap. That's generally the thing. And that's probably why we don't get any importance of carry trades, because carry trades is exactly what you do when there's a lot of liquidity around. When there's a lot of liquidity around, you will take risk. You will be willing to buy something of lower quality, and that will be something with higher interest rates where you see higher carry. So the carry really probably isn't measuring carry. It's probably measuring when monetary policy is important or not, whether the global monetary machine is broken. So consistently everybody talks about in the quant world about carry always being important, but maybe that's because it didn't take into account the global monetary cycle. Likewise, momentum. We find that momentum is important in periods of normal liquidity or easing monetary liquidity. But in periods of tightening global liquidity, momentum means nothing. In fact, if anything, it's at the opposite effect. So momentum wouldn't do well when the Fed, for example, suddenly starting to tighten monetary policy. That could make sense in the sense that what drives the market is whether monetary policy is easing or tightening, and momentum is really trend following behavior. So imagine the Fed is easing and everybody is on that thing, and the given emerging market currency, for example, is rallying, or stock market is rallying, and everybody is following a momentum trade, and suddenly the Fed says, hey, stop. That's what we had, for example, in late 2015. The momentum trade breaks down. The momentum trade underperforms. And what we actually see as the very, very most important factor during monetary contraction, and that's the only thing one should focus on in periods of monetary contraction, that's quality. On the currency side, when you have global monetary contraction, you buy quality. That could be high income countries, countries with strong institutions, countries with strong current account situations, strong public finances, general macroeconomic stability, all of these things. We know how we define that. That's very highly correlated credit ratings. So what am I saying here? Well, these are all very preliminary results. We hope to make them available to clients. I hope also there will come some academic work out of this at some time during 2019. But we keep on working on this. And this, what I'm saying here, is basically just my input to the discussion within the quantum sphere. To all the quants out there, and particularly to those with Chicago background, maybe Fama is the place to start when monetary policy is great, which it overall is. So when we're in a period of from the early mid 80s to 2008, that's a period of the great moderation. That's a period where the monetary machine was working. Nominal GDP growth was stable. Inflation expectation was well anchored. Your quant models probably did well. Then you had a period of total breakdown. And that was a monetary event. That was not a financial crisis. That was a monetary event. Milton Friedman would have told you money demand increased relative to money supply, and that's why you had the Great Recession. And so until the Fed got back to reestablishing some new framework or new rules, and that probably happened already from 2010, we started a new trajectory in terms of nominal demand. Inflation expectations became fairly well anchored. Everything began to return to something, and probably could establish some relationship that was similar to what we saw during the Great Moderation in terms of factors, different factors. But the important thing is to understand what happens with the importance of different factors when the monetary regime breaks down, the monetary regime or the monetary machine breaks down. I haven't seen any research on that. So, well, at Markets and Money Advisory, we will try to do more on that. What's really interesting is a period of monetary instability, whether you have hyperinflation or deflationary shocks or de-anchoring of inflation expectations in some way and nominal growth expectations in some way. What happens to the importance of different factors, whether quality, valuation, momentum, and so forth. Whether we talk equities, or talk FX or fixed income, these factors are tremendously important. I hope this will inspire some to do some research. We will do some research, and if you want to participate in that research, are interested in those discussions, feel free to drop me a mail. I'm very happy to discuss this, and yeah, since this has been shared on Patreon, remember to join and support us on Patreon. Then I will do more of this while I try to serve our clients as well. Thank you very much.